Welcome to our channel, Stock Market Analyst. Today, we're breaking down the basics of stock market indices, focusing on the S&P 500, NASDAQ, and TSX. By the end of this video, you'll have a clear understanding of what these indices are and why they matter. Don't forget to like, subscribe, and hit the bell icon for more investing tips. What is a stock market index? A stock market index is a measurement of a section of the stock market. It is calculated from the prices of selected stocks, typically a weighted average. Indices are used by investors to describe the market and to compare the return on specific investments. The S&P 500. Let's start with the S&P 500. The S&P 500, or Standard & Poor's 500, is one of the most widely followed stock market indices in the world. It includes 500 of the largest publicly traded companies in the United States, representing a broad cross-section of the economy. Companies like Apple, Microsoft, and Amazon are part of this index. The S&P 500 is often used as a benchmark for the overall performance of the U.S. stock market. The S&P 500 was introduced in 1957. Over the years, it has provided an average annual return of about 10%. The NASDAQ. Next up is the NASDAQ. The NASDAQ Composite Index includes over 3,000 stocks listed on the NASDAQ stock exchange. It's known for its high concentration of technology companies, including giants like Google, Facebook, and Tesla. The NASDAQ is often seen as a barometer for the tech sector and growth stocks. The NASDAQ was launched in 1971. Historically, it has shown significant growth, especially during the tech boom, with an average annual return of around 9%. The TSX. Now let's talk about the TSX, or Toronto Stock Exchange. The TSX is the largest stock exchange in Canada and includes a wide range of companies, from financial institutions to energy firms. The TSX Composite Index is a benchmark for the Canadian stock market and includes the largest companies listed on the TSX, such as Royal Bank of Canada, Shopify, and Enbridge. The TSX Composite Index was introduced in 1977. It has provided an average annual return of approximately 6-7% over the years. Why stock market indices matter? Stock market indices are important because they provide a snapshot of the market's overall performance. Investors use indices to gauge the health of the economy, track market trends, and compare the performance of their investments. For example, if your portfolio is outperforming the S&P 500, you're doing better than the average market return. How indices are calculated? Indices are calculated using different methods. The S&P 500 and TSX use a market capitalization weighted method, meaning companies with larger market caps have a greater influence on the index's value. The NASDAQ composite is also market cap weighted but includes a broader range of companies, giving more weight to tech stocks. Investing in indices. Investors can invest in indices through index funds and exchange-traded funds, ETFs. These funds aim to replicate the performance of a specific index by holding the same stocks in the same proportions. Investing in index funds is a popular strategy because it offers diversification and typically lower fees compared to actively managed funds. To sum up, stock market indices like the S&P 500, NASDAQ, and TSX are essential tools for investors. They provide a snapshot of market performance, help track economic trends, and offer a way to invest in a diversified portfolio. Understanding these indices can help you make more informed investment decisions. That's a wrap on our overview of stock market indices. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and share it with your friends. Have any questions or topics you'd like us to cover? Drop them in the comments below. Happy investing!